Welcome to Money Mondays with Jeff. We have a special episode. It's going to be like a little masterclass here. I got the one, the only Mr. Jamelle Nelson, who is a seasoned CPA. My man got 15 years of experience. He's with his own boutique financial services firm. He worked with Fortune 100 companies. I mean, he is the real deal. And we're coming to give a little information for high income first generation wealth builders on how they can keep more of the money that they are making. So if that resonates with you, then this is the Money Monday for you that you want to make sure that you do not miss. Welcome, 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 Mr. Nelson, CPA extraordinaire. How you doing today?
Oh man, I'm doing much better after that intro. Love that intro.
I'm gonna take my glasses off and get comfortable because we talk about having a little talk, like a little masterclass to kind of hip high income first generation wealth builders and give them some information on how they can keep more of the money that they're making under their management. So it's important that I wanted to have this conversation with you so we can be able to educate, because information changes situations for many of the people that are out there. So I'm so happy and so grateful that you came on Monday Mondays with Jeff today to kind of spread some of your knowledge and sprinkle in some of your wisdom as how you are planning and building this money game for yourself and your clients. So can you just give us your little 2-minute story and how you got into being a CPA and what motivates you to keep, doing the thing that you're doing?
Absolutely. So before I actually get into that, I want to first thank you for inviting me to this panel and to this platform. And I consider this a very special moment, and I don't take it lightly. So thank you for this opportunity.
It's all good.
And just to kind of give people a little background of who I am, as you mentioned, Jamelle Nelson, CPA. I'm the managing director of Nelson Associates, and I actually lead and manage a firm that I founded, and we actually specialize in working with individuals, companies to reduce their taxes, tax plans, strategize, and ultimately keep more of their hard-earned money in their pockets. Our specialty is with the real estate space, so we work predominantly with real estate investors, real estate brokers, agents, you name it. So that is our forte. And in terms of how I actually got started in the business, I actually go all the way back to high school. Believe it or not, I kind of had an early experience about the field of accounting and working in the space. And the reason that came about was because during my high school time, I participated in this summer program. And this summer program, believe it or not, focused specifically on educating the students in the field of finance and accounting. And that was the very first exposure I had to accountants. Prior to that, my experience with accounting was your typical bookkeeper, your typical tax preparation person. But it wasn't until I participated in this program where I learned about the different career paths, the different specialties, and the opportunities, and those things intrigued me. So early on, I knew I was going to be an accountant. And once I actually got that exposure, it made it easier for me to really start looking at the colleges that I wanted to attend, the major, obviously accounting, and down the street from where I grew up in Los Angeles. Down the street from the school or from the house was USC. And at the time, USC had the #1 accounting program in the nation. So my choice was pretty much made up at that point. I was going to be an accountant. Now, did I know I was going to have my own firm and do what I'm doing now back then? No, but at least I had that start. I had that idea. And eventually I went on to USC, did my studies there. Directly after graduating from USC, I went to go work with KPMG. And KPMG is a Big Four accounting firm. And if you actually go to school as an accountant, the holy grail is to go work for one of the Big Four firms. And if you get to work for one of the Big Four firms, you pretty much made it. So I was able to do that. But after about 3 or 4 years of doing that grunt work and working that lifestyle, I realized, hey, this is actually not all that I thought it was going to be. I don't think this is what my thought of being an accountant was going to be. So after getting some experience, you start getting headhunted out by different firms, different competitors, and they pretty much try to steal you away from the big four firm because they know you have the experience and they're going to pay a little bit more money. So I actually took my first opportunity outside of KPMG, and I went to go work with a company called CB Richard Ellis. And CB Richard Ellis is the largest real estate firm in the world. And during that time, that's when I got my first exposure experience to real estate. And during that time, I was responsible for accounting for the monthly accounting, the financial reporting, technical accounting for all of their subsidiary groups, their investments. And that pretty much gave me an interest in real estate. And similar situation, got headhunted out of there after a couple years and went to another competitor of theirs where I focused on pretty much the same work, working with companies to help them tax plan, tax strategize, and ultimately got promoted and moved up and had an opportunity to actually go do some consulting. And as I became a consultant, I started to pull everything together in terms of my technical background, my business development, my sales skills. And that is what ultimately gave me the vision to, hey, I can actually do this myself. And I can actually go out and work with the clients that I really want to work with and the clients that I really want to help. And that's how Nelson Associates became Nelson Associates.
So you're on the West Coast, so I guess you rocking that they not like us is high in your rotation right now. I assume, right?
You already know it. You already know it. So born and raised in LA. Yep. Like I
let's
said.
jump right into this. Like, so for
Yep.
first generation high income earners, right? So what are some of the fundamental tax saving strategies? First generation, because this is their first time making some money. They the first ones in the family. They doing 6 figures or more. They comfortable right now. But oftentimes they only limited to a few strategies because oftentimes many of them are C-suite executives, they're W-2 employees. So what are some fundamental strategies first generation high income earners they should be aware of?
That's a great question. When we talk about fundamental, I don't look to make it complicated. I look at the basics. And oftentimes when we're talking about fundamentals, the basics aren't being met. So the very first thing that I will look at and recommend is to make sure that you're actually executing on the basics. And what I find oftentimes is when individuals and clients come to us, they're looking for that easy fix, or they're looking for that that fix all pill that's going to be like their savior for tax planning, and they're not even doing the basics. So the basics for me in terms of a first generation high income earning individual is to make sure that you're actually maxing out your 401k. If you're a W-2 employee or if you're working with a company, they oftentimes will match whatever you put into the 401k. So understand that there is an opportunity for the company to put extra dollars on top of your contribution, and understanding what that limit is and what the most is that you can contribute. And if you actually do that, you could essentially kind of help defer some of your taxes as well as deduct some of your taxes that would otherwise be taxable. The other thing would also be looking at your IRA's accounts. Depending on where you're at in that high income range, you may be able to qualify or you may phase out, but you still want to be able to take advantage of those things as well. And then there's also some other easier ones as well, such as like your HSA activity. If you do have an opportunity to contribute to an HSA, it may not be a whole lot, but every little bit counts. And at the end of the day, we want to make sure that you are aware of these basic fundamental starters before you really start executing on the bigger, more complex items. Hey, Jeff, I think you got frozen on me. Can you hear me? All right. Hopefully it's not me, but I think Jeff is a little frozen right now.
Technology is spazzing out on us tonight.
I
I
he's
know
you.
it's hot
Did
over
you
here
hear?
it's
Yeah.
hot over here on the East Coast. I don't know what it's looking like on the West Coast, but this
Yeah,
technology
we
is
got
great
some.
when it works.
It is. It is. So I'm
But
hoping you
you
caught
kind of
some of
you
what
cut
I said.
yeah, you cut off at the last point when you talk about maximizing the HSA. So could you really tell people like what the HSA is and like and then
Absolutely.
continue on where you were?
Yep, absolutely. So the HSA is a opportunity where if you do have a employee-employer relationship, your company may be able to provide that as a part of your health benefits. And depending on what type of health plan you've set up for or elected, you will have an opportunity to add the HSA component to that plan. And the HSA is essentially you being able to contribute to this special health plan, and the contributions are going to be tax deductible, and you can actually use the funds for purposes that may be in addition to what your normal insurance will cover. And if you are to use those funds for medical purposes or reasons, it is non-taxable. So it's a huge benefit. It does provide the tax deduction capability for you. However, there are limits to how much you can contribute and benefit on an annual basis. So it's not necessarily the greatest strategy and tactic, but it's one of those fundamental things that you should be aware of.
We're talking to Jamelle Nelson, CPA of Nelson and Associates, and we're catering this as a little talk masterclass for first generation high income earners. So one of the things that I see in my practice when I'm talking, with these first generation high income earners is that they have already maximized their 401k. They've done all of the standard deductions if they're a W-2 worker. And one of the things that I like to strategize is that making sure that they have some strategies in their portfolio that they can pay taxes one time and then put it into an account and then let that account grow without it ever having where it can grow uninterrupted, compounded, and not be taxed again. I know a lot of things that you talked about, and one of your specialty is in real estate and how you like to utilize real estate as a strategy to reduce and or eliminate taxation on high income earners. So could you talk a little bit about how is there some other ways that you could maximize deductions and get some credits to reduce your taxable income if you're making a lot of money and you don't want to continue to give away this money unknowingly and unnecessarily to the Internal Revenue Service?
Absolutely. Absolutely. So, in terms of my motto and my phrase, my motto is pretty much if you want to save as much money as possible and kind of shield that from the IRS, you have to do more than just be a W-2 employee. Because if you're just a W-2 employee, they're going to get their cut regardless. But how you can actually start to manipulate and change that scenario, you ultimately have to either be a business owner or you have to be a investor. And you don't necessarily have to be a real estate investor. You can be an investor in the stock market. You can be an investor in other ventures. But you do have to have one of those two things going in order to maximize your scenario in which you could potentially be saving. But before you even get to that point, I think it's important to have an education and understanding of really how the taxes work. So you're obviously going to make money, and whatever your taxable income is, if you have any income coming in, it may be taxable, ideally. And once you understand that, you now need to understand what your deductions are. You need to understand what your credits are. And this is where you start to implement and utilize some of these other avenues to help you offset some of your taxable liability. So you mentioned real estate. Real estate is a huge opportunity if you are a high income earner to help shelter some of your income from taxes. And you would do so by understanding how you can utilize real estate to identify deductions. You can actually benefit from real estate from a investor, or you can benefit from real estate as a primary homeowner. And there'll be benefits on both sides, but one of those avenues will provide much more greater benefit than the primary homeowner, and that benefit being greater on the investor side. So I think it's important to understand really the differences between credits, deductions, how they work, and how they really impact your overall taxable equation.
Cool. I was reading a couple of days ago, Caleb Williams, who is
Yep.
the new quarterback for the Chicago
Yep.
Bears. He had a
Yep.
very unusual request about his compensation from the Bears. And he actually went to them and was like, I don't want you to pay me as a
Yep.
W-2 employee.
Yep.
I want you to pay me as an LLC. So,
Yep.
but of course, the Bears declined that request because, you
Yep.
know, it's a lot of revenue for the federal and the states come from that tax base being a W-2. So I thought it was kind of interesting that he actually wanted to be paid as a LLC as opposed to W-2. So
Yep.
one of the things I wanted to ask again is, you mentioned real estate and how real estate gives some additional tax benefits, and you mentioned how the Internal Revenue Services, the tax code is primarily written for the business owner and the landowner. So, do you see, if you are that first generation high income earner, is there some effective tax strategies that you should be looking at when you are investing in stocks, investing in real estate, or starting your own business?
Absolutely. Absolutely. So first off, I saw that article with Caleb too. Shout out to Caleb. I
With the
actually
request,
went
right?
to SC, so he's from my alma mater. But to that point, one of the benefits or one of the real push for Caleb to try to get his compensation structured through his LLC is that he would have been able to pretty much offset that income against business deductions. So as a business owner, you obviously are going to be in business to make money. And if you have taxable income, you get taxed on that unless you have deductions to offset it against. So in that case, that would have benefited Caleb much more than if he was just a straight up W-2 employee, because as a W-2 employee, you do have deductions, but they will be nowhere near what they are if you are a business owner. So when it comes to other opportunities such as investing in real estate, investing in stock market, you have an opportunity to make a lot of money in those areas, but you also have opportunities to identify deductions. And the more deductions you can identify, the more losses or benefit you can offset against those tax implications. So in the case of a real estate investment, you obviously, if you have that investment for the purpose of generating passive income or primary income, you now not only can benefit from that cash flow, but you can benefit for things such as depreciation expense, which is a non-cash item. So it doesn't cost you anything out of your pocket to identify depreciation expense, but it's pretty much what they call a phantom loss. On paper, we can identify these losses, but in real life, it really didn't happen. But on paper, we can. So this is a way to really strategize and manipulate the tax code so that it can benefit you in your favor. Same thing when it comes to investing in stocks and stock market. Not every investment in every company you invest in is going to provide a positive result or a profit for you. Sometimes there may be losses. And if you do have those losses, you're now using those losses to offset some of your taxable income. So you have to understand how all of these different things could potentially benefit you. And they mostly will benefit you if you are able to identify losses or deductions.
That's really interesting. That kind of leads into my next question. One of the biggest mistakes I see people making is that they oftentimes rely on going to get their tax advice from places like H&R Block, and the little services that are basically just designed just to take your information and not provide you with any kind of tax strategy. And I believe
Yeah.
that tax strategy is so important, and having a skilled professional on your team to kind of help you to navigate through taxes is so very critical, especially when you're on the road to building wealth, and especially when you are a first generation high income earner.
Yeah.
Having a tax professional in your corner that has a specialization in taxation is so very key. And I see oftentimes that's one of the biggest mistakes that high income earners have by not having that in their portfolio. Of course, not having someone like me as well contribute to that, mistakes that they're making. But one of the things I wanted to ask you is that what are some other common tax mistakes you're seeing first generation high income earners make, and how should they avoid them?
That's another great question. So I'm gonna kind of stay on line with the first kind of comments you made regarding levels of services and different professionals. So first and foremost, one of the first mistakes that I do see first generation high income earners falling into is that they may associate a specific professional with another specific professional. What I mean by that is they may mix up or confuse the level of service and experience they may be getting from a tax preparation service versus someone that is a tax planning expert or a tax specialist.
It ain't the same.
It's not the same. And the reason they want it to be the same oftentimes is because they're looking for paying the lower cost. They're looking for paying the least amount of fees. But obviously, as you know it, the cheaper the fees and the cheaper the cost doesn't necessarily mean you're going to get the better service or the better treatment and the better results. So I think that's the first thing that I see oftentimes, mistakes being made. Not really understanding the true value of the professional and that person that comes with more experience. Another mistake that I see oftentimes is that they really don't do their homework, or they have no idea what the scenario or situation is when it comes to professionals. And what I mean by that is they may go to a regular CPA, not necessarily a regular CPA, but any CPA, thinking that that one CPA can do everything that they need done. And I'll be honest with you, even though I had my career experience working in corporate, prior to me starting my firm, I didn't have as much hands-on experience working with specific details that I do now. Truth be told, I didn't even prepare a tax return. I was very specialized in financial reporting. I was very specialized in technical accounting, but I wasn't an expert in tax return preparation. So depending on what your need is and what the level of, or what the goal is for your situation, you have to pretty much be prepared in asking the questions of the professional you're working with. You got to do your due diligence, and you got to make sure that that person is really the best person for your role and or for what you need. And I typically kind of compare it to, hey, if you ever broke your foot, you're not going to go to the doctor and ask for a cardiologist. You ain't going to ask for a brain surgeon. You're going to ask for the person that specializes in foot issues, right? So it's the same thing when it comes to the profession of accounting and being a CPA. Oftentimes, I find clients, they may have real specific questions about real estate and tax strategy for real estate, and I'm the right person to come to. But if they are here for maybe a different level of service that I don't necessarily specialize in, such as maybe e-commerce or sales tax for internet sales, I may know about it, but I'm probably not the expert. So you may not necessarily want to come to me for that level of advice. So I think that's the biggest mistake that I see oftentimes, really not doing the due diligence, not understanding that there's different levels and different professionals that specialize in certain areas and industries, even though they all may have a specific common degree or certification.
So just to follow up on that, if someone is like trying to vet to see if this tax professional is the right one for them, what are some questions that maybe they should go in with to kind of see if they got the right fit?
Absolutely, absolutely. So you first off want to ask a little bit about the experience. Some basic ones are obviously, do you have educational experience? Maybe do you have the professional experience, career experience? Not only that, but more important, how many clients do you have, or who do you work with? What type of clients do you work with? What type of results have you provided for them? Those are some of the things that you look at. And then obviously you can do your due diligence and kind of see if they got any foot trail or history on the internet, online, look at some reviews, things like that. But more importantly, you're looking at who are they currently working with? Have they worked with these people before? And the people that they've worked with are those people who I kind of associate myself with, or do they have the same situation that I have? And can this person help?
That's very important too. I know one of the things that I've started, well, I've been doing it for a while to be a value add to the clients that I serve, is that I always like to give them a questionnaire that when they are seeking to find a tax strategist, that they
Yep.
are equipped with some right questions, because you know as you said earlier, it's a difference between someone who's doing tax preparation and tax strategy. And I want my clients to be able to go and meet with their tax strategist like every quarter. And I want them to be able to say, like, where are the incentives in
Yep.
the tax code as it relates to me? And my clients
Yep.
is like, why do I gotta go sit down with them 4 times a year? Because I'm like, yo, they are your they're the superstar on your financial all-star team. You have to
Yep.
be able to see them, to find out where those incentives are, so you can get more of the money back or get more of some credits back to offset your income. So it is imperative to have these kind of conversations, and more importantly, to make sure that these conversations align with your overall wealth building plan, so you could be, positioned to, like, keep more of the money that you're making. I've said
Yep.
this like over and over and over again. Like, taxes are going to be your biggest expense for the rest of your life. And if you don't have tax strategy in place, then just be prepared to have the government be the primary benefactor of your life's work. So you
That's
you
right.
either gonna
That's
pay the
right.
government or you're gonna pay a
Yep.
tax strategist, but you're gonna pay
Yep.
somebody. So you might as well pay
Yep.
somebody that's going to get you some benefits back in return.
Yep. Yep.
So moving
Absolutely.
on, right? I wanted to pick your brain a little bit. Like, how do you stay abreast of all of the potential, tax laws and the tax changes? Like, how do you stay ahead as a tax professional and a tax strategist to make sure you continue to be a value add for your clients that you serve?
That's a great question. And I think that goes a little bit hand in hand with how we could utilize our business deductions to help curtail some of our tax liabilities. So, how I stay abreast, obviously, I have to maintain the status with my license. So, as a CPA, I'm required to take certified professional education classes and hours. So, that is one way to make sure that I stay on top of things, which is tax deductible when I have to pay for those things. Um, I definitely try to attend as many live events that sponsor those things. So if that means I have to hop on a plane or go pay for a conference to get some CPE credit, I'm gonna pay for that, and that'll be a tax deduction there. I may look to join professional organizations. I may look to join professional development groups that specialize in technical areas that I can actually hone in my skills with and or improve. Those are also tax deductible. So really utilizing those opportunities to not only educate myself, but be a tax deduction and a write-off on my business. Um, and then not only that, but working with the clients on a regular basis. As you work with clients, you're going to experience different scenarios. Not every client is the same. Some clients are going to have some far out issues, scenarios. And as a CPA, the job is to really work to ultimately figure out best case scenario for the client. And it requires a bit of research, a bit of kind of putting your head together. So because I am actively engaged with the clients, not only do I work on the business, but I still work with the clients. I'm pretty sharp, and I kind of stay abreast of certain things that may not be so common for your traditional service provider or person that's just doing the regular services.
I'm glad you put it that way, because one of the things um, um, that we focus in here, like especially with more financial solutions and the cash value wealth builders community, we are always building upon getting the information that first generation wealth earners could utilize to keep more money under the management that they're making. So one of the things, on November 1st and 2nd, we're doing this awesome conference that's going to be in Atlanta. It's the Cash Value Wealth Builders Summit. We're going to talk about how to utilize cash value life insurance to not only replace income, which is needed in a lot in the Black and brown communities, but also to utilize that cash value as leverage that you can go out and buy real estate. You can go out and buy stocks. You can go out and, start a business or put money back into the business that you're earning. Because I think the life insurance is not what it is, what it does. And one of the things that it do is it helps you to be more in control of your money and give you some tax benefits in the process along the way. So these are some of the strategies that's going to be on display in Atlanta November 1st and 2nd, and we're going to have high level strategies on how to utilize the incentives in the tax code to help you to keep more of your money. So with that being said, excuse me for the little advertising, but I had to slip it in because just how we do things around here. What is one of the things transitioning? I like to tell my high income first generation wealth earners, especially the ones that are W-2, that they have to get a LLC or S corp. They got to get a side business. They got to get a side hustle. They got to get something that's going to be able to help guys like you position and help them to strategize so that they can be able to take advantage of some of the incentives in the tax code. What are some of the things or some of the tax considerations that first generation high income earners should have if they are managing side hustles, or if they got a gig, a part-time gig in the economy? What's some of the things that they should be doing on a tax side to kind of manage those things?
It's a great question. So I think going back to the basics, regardless if the business is just getting started out or it's been going on for a while, one of the first things that you want to make sure you're doing is keeping good records, keeping good bookkeeping. And this is definitely overlooked, especially at the beginning when someone is first starting out. They think, oh, I'm not big enough, or I don't think I require all of this right now. But even if you don't have a lot of activity and action going on at the beginning, you still need to report on it. And the challenge that I see oftentimes is it starts off pretty small as a small idea, and then it may pick up, and then it may expand, and then it may get busy with activity. And now it's a challenge to try to go back and fix those reporting issues that happened earlier on. So I think part of the issue and things that I think a new person that is looking to get started should be considering and doing is making sure they're keeping good record keeping, making sure they have a good bookkeeping system in place. You don't necessarily have to go out and hire a expensive CPA to do that for you. But if it means getting a bookkeeper, if you can't do it yourself, for sure, look to get a bookkeeper to maybe help you kind of stay on track. I think that'll be a good place to position yourself to now take it to the next step. Because when you start talking about tax planning and tax strategy, and you have these different vehicles like LLCs and S corps, it's a challenge to really provide the most value if you don't have that basic stuff in place. So that's the first and foremost.
Okay.
The second piece is understanding estimated taxes. So this is where a lot of high income earners will get in trouble. They oftentimes didn't always start off making a whole lot of money or being a high income earner. They may have been sufficient just making their regular deductions on their paycheck. But once they start graduating into the area of where they now are participating in RSUs, restricted stocks, once they start participating in stock comps, once their bonuses are bigger than their salaries, they're now in a whole nother scenario than they were when they first started on their careers. And if that's the case, chances are they're not withholding enough money from their paycheck initially. So what that means is they need to be able to make estimated payments on a quarterly basis to the IRS for the taxes that they think they will owe. And you can't do that by just guessing. Like you actually have to put together a projection and kind of look at what your scenario is going to look like, which is where it pays to have a relationship with the tax strategist to help you with those numbers. But understanding that there will be a required estimated quarterly tax payments is huge, because a lot of people overlook that, and then they're surprised when they get their first big tax bill. And the reason is because they thought that the taxes that they had coming out of their paycheck was sufficient and was enough, but that's not the case oftentimes. Where working with a tax strategist or a tax planner can definitely be a benefit is that they can not only help you project what your tax liability will be at the end of the year, but if they see that you're not taking enough money out of your paycheck to cover that tax liability, they can help you adjust it so that you will be taking enough money out. But if you're working with a really good tax planner and strategist, they're not only going to help you project, but they'll tell you what you should do to change that end result so that it's not an amount you owe, but hopefully some money you be getting back. So all of that at the end of the day doesn't happen if you don't have good record keeping or if you don't have good bookkeeping processes in place, especially if you're one that's going to start with an LLC or have an LLC as corp and such.
So when you're looking at these businesses and you're looking at these S corps and the LLCs, are there overlooked business expenses that could, be deducted to help them to even save more money on taxes, like expenses that are common that they're missing?
Absolutely. So I'll go back to the basics. We can talk about high level tax strategy, complex tax strategy, but oftentimes they're not even doing the basics. So some of the basics could be, hey, depending on what your entity structure is, if you're an LLC or if you're a C Corp, S Corp, you may have different ways that you take these deductions, but ultimately, are you making the most of your home office deduction? Are you making the most of your meals and expenses? Are you making the most of your travel? The things that you're doing in your regular daily life. Now that you have a business, we now have to connect that to the business and try to participate the business so that we can maximize. So really thinking outside the box and being strategic with knowing that you are a business owner. So if you are a business owner and you needed to go out and buy a new vehicle, let's utilize that purchase through your business. Or if you're not going to purchase it, let's utilize that lease through your business versus your personal so that we can maximize. So these are some of the things. And then if there's a scenario where we have individuals that may have children, oftentimes if the children are old enough, they should definitely be considered for being on payroll. And oftentimes the parents are obviously spending money on the children, whether it's daycare, whether it's school supplies, whatever the case. Let's be creative and strategize and see how we can now participate this business and involve our family so that we can maximize on our tax deductions. So these are some of the things that are often looked.
Do you find when you're doing taxes that you find people co-mingling money where they're using personal money and business money and vice versa?
I don't know if this is a surprise to you, Jeff, but I would probably say 6 times out of 10, maybe 9 times out of 10, the client is commingling. And it probably takes 1 or 2 times for them to like get slapped on the wrist before they figure out they're not going to do that again. But the way that you don't commingle, obviously, is if you set up your entity structure and if you set up your processes the right way from the beginning. And oftentimes that's not the case because Most of the business owners will probably have a full-time job here, and then they start the business, then it picks up, and they didn't really establish their separate bank accounts. They didn't establish their personal from their business accounts from the get-go. And then even if they do, they still may be using those accounts incorrectly. So it is not uncommon. I oftentimes find the LLCs to do that more frequently than your S corps or your C corps. But typically, if a business has gotten a warning or been slapped on the wrist, it don't require a second or third time oftentimes.
Are there any like valuable tax credits that high income first generation earners should automatically look for that they often don't?
That's a mouthful. The answer is yes.
Okay.
And I'll
Okay.
give maybe real estate for an example. So yes, for real estate. So if you do have a high income earner that is investing in real estate, there may be some special credits allowed there that may not be allowed in any other industry. And what I mean by
Can you
that
touch
is,
upon a few of them?
yeah, I'll name a couple. So in terms of like investing in real estate, if you were to invest in a specific area that is considered an opportunity zone, that means you're pretty much investing in a maybe lower income area, and the government wants you to, as an investor, put your money there so you can revitalize that area. So they may provide tax credits that way. So those could be a few strategies that you would consider. They may have opportunities for you to take advantage of energy efficient appliance or installations or things like that. So those are some things. If you know you got to get, if you know you're trying to save on your utility bill and you're living in an area that is like a high heat area, and you may need to put solar panels on your roof, and we're probably talking single family, or we may be talking big multifamily project. That could be an opportunity to get a lot of tax credits there. And even as a single individual, like if you're purchasing a electric vehicle, there's smaller tax credits there. So there's credits available to the individual, and there's credits available to business owners, and there's specific credits available to a specific industry, depending on what you do. And as I mentioned, because the real estate space is my specialty, I have a lot more knowledge about the credits specifically for real estate than I would for a lot of the other ones. Not that I couldn't figure it out, but that's not my specialty, right?
I love it. I love it because I believe that, real estate, business ownership, and life insurance are like the three biggest and best places that, from a tax perspective, that you should definitely have in your portfolio, especially if you're a high income, earner, because those are going to be the three areas that's going to give you the biggest bang, the biggest deductions, the biggest appreciation, the biggest leverage that you're ever going to have. So that's why I love to bring people on like you to kind of like to facilitate that conversation, because many people are intimidated because they think it's a lot to invest in real estate or to invest in having your own business. But that is where all of the incentives are. They are
Yep.
in real estate, they are in business ownership, and they are in life insurance. That's what,
Yep.
because those three things that you're doing that the government doesn't want to be responsible for. So those are the places where the government is going to have the biggest credits. So
Absolutely.
is
Absolutely.
there any other fun fact about taxes, you know, that are very surprising that many people don't know that can save them more money on taxes? I know you gave a lot in real estate, and I know that's your specialty. But are there any other fun facts or any other surprising tax facts that you might know of that outside of real estate? Because I know you can do this
Yep.
thing about real estate all day. You just gave us
Yep.
some great examples, but I want to make sure that we touch upon some of the other ones that are maybe in some other areas.
I would say, in terms of like the fun facts, accounting is accounting, taxes are taxes, but the tax code is wide, it's vast, it's huge. It's impossible to know the tax code like the back of your hand, from front to back. And the reason that is because it's always changing. Like the tax code is changing consistently and constantly. But I will say, in terms of like the fun facts, regardless of what the industry is, there's a few common principles. And those principles, if you understand what those principles are, you can certainly be at an advantage to someone that doesn't necessarily take advantage of being proactive and kind of learning how the basic principles work. And the basic principle is pretty much, hey, how much money are you making? And let's do some projections to figure out how much the IRS is going to tax us. And if you understand what that number is and how you can actually work backwards and that you have the ability to work backwards, I don't care what industry you're in, now you have an opportunity to use real estate. You have an opportunity to use setting up an LLC. You have an opportunity to use S Corp. You have an opportunity to use life insurance to now say, hey, now that I know where I'm at, now where am I going to go if I don't do anything? If I'm here today, where am I going to be at the end of the year? Okay, fine. Either I'm going to be okay with paying those taxes or be angry, but it is what it is. But if you're not happy with what your scenario will be, now you know, okay, if this is where I'm at, how do I work backwards and move backwards to actually reduce? And that's the beauty of like those principles. If you understand kind of like the mechanics of that, it doesn't matter where you're at, what you're in, like there's an opportunity for you for whatever your industry is to reduce and improve that situation.
So do you think taxes are going to be higher or lower or about the same in the future?
It all depends on who's in office, right? So whoever is in the office, they're going to push for more taxes to go to the less fortunate, to the social efforts. And depending on who else may be in office, they may push for more credits, for more.
Okay. That was the great political answer. But I want to know personally. Like let's just this personal.
Taxes ain't going nowhere. Taxes ain't going nowhere. I think taxes.
You think they'll be higher?
I think taxes will increase. I think taxes will increase, but the benefit of having these conversations and knowing how to play the game, you don't have to be a victim to taxes increasing. Like if taxes increasing, if they do increase, I'm not going to lose any sleep because I now know I just need to figure out what that new rule is, because if they increase, that means there's a rule that will offset that increase. And if we know what that rule is and what the politicians put into place and approve, now we just got to play that game with them. Because I can guarantee you they're not being victimized by the high taxes on their end. They know how to play the game, right? They created the rules.
So what's your money strategy for creating generational wealth going forward?
Having these conversations, educating my kids about money, educating the importance of saving, being diligent, understanding the importance of owning a business, understanding the importance of real estate, investing. Those are all of the things that I hope that my children will grasp and understand, so that not only I can pass on what I've built up, but they can actually do the same with their kids as well.
That's awesome. See, I asked you that question because my strategy and my approach is I want to buy as much cash value life insurance that I can possibly own. I want to have the max that the insurance company is telling me you cannot buy anymore until you make some more money. So that's the foundation. And then I'm going to structure my cash value in such a way that when opportunities come my way in real estate and opportunities come my way in business ownership, opportunities come my way with the stock market, I got a pool of cash that I can go and take advantage of that opportunity that's going to make me some additional money in another place that's going to give me some additional tax benefits. And then I'm going to take all of those proceeds and then dump it back into my life insurance. So I can have this perpetual cycle of making money, investing money, leveraging money, keeping money, so I can enjoy the money at my tax advantage. And I'm trying to teach as many people possibly how to incorporate that strategy, because I think it is really a fail-proof financial strategy, especially for creating generational wealth, because I'm going to use the life insurance leverage to build a moat around all of the financial castles that I'm building right now. And I think it's just one of the most underutilized strategies, for wealth building today, especially in the Black and brown communities. So I'm trying to do a little bit something to change that narrative so we can
Yeah.
start taking advantage of what some of
Yep.
these rich folks are doing and
Yep.
what they've been doing
Absolutely.
over the past 100 years, you know?
Absolutely. Absolutely.
So I got one more final question for Mr. Jamelle Nelson from Nelson, seasoned CPA, 15 years in the game, been working for all these Fortune 100 companies, got your own practice now, Mr. USC. I ain't want to give you no props because they beat my team in the bowl game a couple years ago, but I haven't gotten over it yet. But it's all good. I'm still in
You can
counseling,
only have
getting
one
over
winner. You can only have one
those.
winner.
So, but I'm a Penn Stater to the day I die. So that's a good thing. One of the things I wanted to find out before we leave today, what is one piece of wisdom or advice about wealth building that you believe everyone should know, regardless of their field or their background?
That's a great question, man. Repeat that one more time.
I said, what's one piece of financial advice, one piece of financial wisdom about wealth building that you believe, I'm talking about you,
Yep.
believe everyone should know, regardless of their field or the background that they're in?
I believe for me personally, understanding that you need a team, understanding that you can't do it alone, you can't do it by yourself. You can go far by yourself, but you can go further when you have a team. And when we look at a team, we look at your key pieces around you that will help promote what your goals are. They will help promote what your vision is, and they'll help keep you accountable, and they'll help keep you on track with obviously achieving those. So when we look at team, that could be anything from a financial perspective. As we're talking now, your team could be your financial advisor. It could be your Jeff of the world. It could be your CPA. It could be your lawyer. It could be your legal team. Regardless of what your situation is, if you enlist others that may have more experience, that may be expert or specialist in their specific areas that can help you move further along, I think that's the key to really like doing it a lot faster and building it bigger.
Man, that is excellent. I always say that you need a guy like me on your team that's going to be an insurance strategist and a financial strategist. You need an investor, someone who knows how the stock market plays and how to maximize all of the entities that's in the stock market. You need a thorough attorney, because estate planning is where a lot of people lose money unknowingly and unnecessarily. And of course, you need a tax strategist, because taxes are going to be the biggest expense for your rest of your life. And when you have that whole team working in harmony, it is impossible for you to financially lose. So
Yeah.
I employ everyone, to make sure that you get your team together and that your team is in sync with what you're trying to accomplish with your money, so you can be able to maximize the things that you're doing and live life on your terms. So, Mr.
Yeah.
Nelson, thank you for coming on Money Mondays with Jeff today. I am so appreciative that you
Absolutely.
spent the last hour with us, giving your insight and giving your knowledge. I want to make sure that you share us your information so people can get in contact with you if they have any tax related strategy questions, how they can reach you. If they need a tax strategist in their corner, how can they reach you? If they need to go over some real estate arbitrage strategies, how they can reach you. Drop your information so the people will be able to reach you, Mr. Nelson.
Absolutely. So I believe I'm on Instagram as Jamelle_Nelson. That's JAMELLE_Nelson. You can find me there. Same name on Facebook. And you can actually visit us on our website, jnelsongroup.com. That's jnelsongroup.com. And you can definitely find our contact information there, whether it's email, phone number. We're available. We're able to assist. And as I mentioned before, we specialize and do our dirty work in the field of the real estate space. So anybody that's looking for expert in that space, that's who we are.
Awesome. You've been on Money Mondays with Jeff. Make sure you like this. Make sure you share this, because you know some people who need to get this information from this episode. So make sure you like it. Make sure you share it. Make sure you comment it, so we can be able to stay alive on all this social media, as they say, the social media streets. Make sure you like, share, and comment, and we will see you next Monday. Drop a comment. Let us know that you appreciate the work we're doing, and we appreciate you as well back in return. And I will see you next Monday with another dope financial professional giving you strategies on how you can keep more of the money under your management while you're building wealth strategies for your generation, for you to be able to be in control and live the lifestyle that you've imagined on your terms. We will see you next Monday for more Money with Jeff. Have a great day, guys.